Stocks moving higher this morning on the back of dovish commentary from the Bank of Japan. So what could this ultimately signal for global central banks and also markets moving forward? We want to bring in Stuart Kaiser. He's head of U.S. equity trading strategy at Citi. And Stuart, it's great to have you here. So as we stand today, we're looking like we're going to open here to the upside coming off of yesterday's gains. I guess the question most investors are asking, is the worst over? What do you think?
Look, we think the market overreacted a little bit to the jobs data on Friday. So I think the market is kind of digesting that fact that, the data was weak, but it wasn't horrible. We got a bit of a pullback on Monday. I would kind of put those in separate categories. You had the market responding to the data, and then you had something that was a little more yen carry / positioning driven. The positioning part of it seems to have calmed down a little bit. The data part's going to be ongoing. We have jobless claims tomorrow. We have to see how that prints. The fact is we are in a period of slowing U.S. economic growth, and the market is constantly debating right now, is that going to soft land or hard land? Mm-hmm. And how do I tell the difference between the two in real time? So I think what you saw Friday is people got a little bit, shocked or scared out by that weak labor market report. And that's just going to be an ongoing process, I think, over the next kind of 2 to 3 months. Claims on Thursday important, jobless data, payrolls data, in early September will be very important too. So that's an ongoing issue.
I mean, we saw sweeping de-risking during that sell-off here. What type of risk appetite should investors still be considering, at least as we're seeing some stalling out to the declines right now?
Yeah, look, I think what you saw early Monday and a little bit yesterday was a little bit of opportunistic buying in kind of favor stocks. So, I don't think this is the case where you just go all in back on risk. I think this is the case where you have a stock or a sector or a market that you were sort of predisposed to own anyway, and now you potentially kind of buy into that. And I think that's what we're seeing. I think kind of what happened on Monday, you did get a little bit of opportunistic buying, but a lot of the portfolio managers we talked to were kind of asking the question, am I missing something? Like, I didn't expect the market to react this strongly, and it did. And I think, look, when people get a little bit confused or a little bit uncertain, they tend to pull back on risk appetite. And I think that's what happened. It's just going to take a little time for things to calm down and get people re-engaged.
Sir, what do you think? When you take a look at the dramatic move that we saw on Monday, how much of that is a result of the growing popularity of options trading? And I guess to that end, then, how much does that ultimately maybe potentially introduce more risk to the market going forward?
Yeah, look, I don't think the move Monday had a lot to do with like zero data and tactical option trading, mostly because it was coming off a weekend, right? So your Friday one-day options had expired. Mm-hmm. The VIX, when it got to 60, that was pre-market open. You couldn't even really trade that if you were a retail investor. So, I think what it did is it probably put people on edge and got a little bit worried that this could kind of cascade. But, I don't think like the short-term tactical retail options trading had a whole lot to do with Monday just because it was coming off that weekend.
But does it add more risk to the market potentially going forward?
It does and it doesn't. I mean, by definition, a zero-day position is over at the end of the day. So if you lost money on a zero-day option on Monday, it's because you made the decision on the open to sort of purchase that. Mm-hmm. There has been a lot of volatility selling in the market in general. You have zero-day, you have one-day overwriting ETFs, you have a lot of vol selling ETFs. So I think there is some concern that if you get a large surge in volatility, that positioning kind of needs to rebalance itself and can cause a little more short-term dislocation. But if you look at Monday across the space, it was really the VIX that looks like the outlier. The VIX getting up to 60 was highly unusual compared to the moves we saw in other parts of the market. I think that suggests you might have had some positioning dynamics on the VIX specifically that were going through the system.